to take the consent calendar after the presentation item, so we'll move to presentation item number 1, CFO Thomas.
Good evening, directors, Chief Wells. I'm here this evening to present the financial report for the fiscal year ended June 30th, 2016. So that's our fiscal year 2015-16. And I do want to emphasize that the numbers that we'll be talking about tonight are preliminary, unaudited results for the fiscal year. The numbers certainly will be adjusted as a result of the audit process and as we continue to collect revenues that are attributable to the prior fiscal year. However, we are here tonight to present these preliminary results, and then we would expect to be back probably sometime in early 2017 to present the final results along with our CAFR for fiscal year 15-16. So taking a look first at our cash balance history. So this chart is showing you what our total cash balance was throughout the year, with the red line being the fiscal year that was completed at the end of June 2016, and the green line being the prior year, and then the purple line being the year before that. You can see that we ended the year with a total cash balance of about $52.5 million. That is cash balance in all of our funds. Almost half of that is our pension stabilization fund. About 40% of it is our general fund, with the remainder being the other funds that the district holds. You can see that ending cash position for 2016 is similar to, slightly higher than where we ended the fiscal year 2015. This next chart is showing us our general fund operating reserve. So this is different than the cash balance, because what we're showing here is the reserve amount, and we're looking specifically at the general fund. So the way that we calculate the reserves in the general fund is we start with the beginning unassigned reserve or general fund balance as the beginning of the fiscal year, and then we're going to add in all of the revenues that we have attributed to the fiscal year, subtract the expenses for the fiscal year, and then that's going to give us our ending balance in the general fund reserve. So looking at the chart at the top, there's that dashed line that goes across the chart, that dashed light blue line, and that's showing where we projected, based on our budget for the fiscal year, that our ending reserve would be, which was about $20.5 million, representing about 11.6% of the net budgeted expenditures. You can see that looking at the red line, which is showing us the actual results for the fiscal year, that we ended up above that amount. So the 20.5 million projection was based on a use of reserves during the fiscal year, a budgeted use of reserves of about 2.1 million. We ended up, based on our actual spending and revenues, generating a slight surplus of about $350,000. So that improvement compared to the budgeted results resulted in us adding slightly to reserves at the end of the year, as opposed to using that $2 million in reserves during the year. So looking at the top line on the table below the chart, you can see that we started with a reserve of $22,577,000, and then we're ending the year on that bottom line at $22,928,000. So you see that improvement of $350,000 or so. And that 22.9 million ending reserve balance represents 13% of our net budgeted expenditures during the year. So looking at how we did on our revenues, this first chart is showing our medic cost recovery revenues, with the blue line being the budgeted number, the red line being our actual results for the year, and then the green line being prior year results. So we have budgeted for revenues of $33.8 million. What we're showing here for our actual revenues are the actual cash receipts during the year, so what we collected from July 1st through June 30th, and that was about $32.9 million, so about $1 million less than the budgeted number. However, this is one of those items that we know will be adjusted as a result of the revenues that we're continuing to collect. So when you look at the red line here, what we're showing as revenues for July, August, and September, those are the actual cash receipts for those months of the year. Some of those receipts were related to transports that occurred in the prior fiscal year, and that money was recognized as revenue for the prior fiscal year. So we will do an adjustment in the audit process to remove that revenue from our fiscal year 15-16 total. And then what we'll also do is we'll look at revenue that gets collected in July, August, and September of 2016, and that is related to transports that happened prior to July 1 of 2016, and we'll add that to the revenues for 15-16. So to the extent that that's a positive number, the difference between those two, that will increase the total revenues. To the extent it's a negative number, it would decrease the total revenues. And just for a point of reference, we had about $800,000 that got added as a result of that process in fiscal year 14-15. Looking at our total revenues, we had a budget of $184.3 million and actual revenues of $183.4 million. And the difference between the two, well, first of all, the primary factor contributing to the fact that our revenues were below budget is that we had an IGT that was budgeted in 15-16, which was a preliminary Blue Cross IGT that we thought would occur in 15-16. The timing of that shifted out, so it's now occurring in this current fiscal year. So there's about $2.2 million of the revenue budget that was not received because of that. You can see that overall we have about an $800,000 variance between our actual and our budget. So that means that we made up for some of that $2.2 million from other revenue sources. So better than budgeted results for other revenue sources, including our property tax revenues. I did want to point out that while the impact of that IGT on the revenue number is $2.2 million, there was also $1.3 million in expense associated with that IGT that we also didn't see spent out of our expense budget, and I'll point that out when we get to that slide. So looking now at expenses, this chart is showing our salaries and benefits expenses, and you can see that out of a budget of about $152.3 million, we spent $151.9 million roughly, or about 99.7% of the budgeted amount, and that represented about a 7% increase from our prior year salaries and benefits expenses. Looking at total expenditures, out of our budget of $186.4 million, we spent roughly $183 million. And so there's a $3.3 million total variance between actual and budget there. As I mentioned earlier, $1.3 million of that is the result of that IGT that was rebudgeted from last year to this year. So that leaves about $2 million in other areas, about $500,000 of that being labor, and about $1.5 million of that services and supplies budgeted but not spent. And then finally, looking at our SERP fund, which is our OPEB trust, we ended the fiscal year with a balance in that trust of about $19.7 million. That's made up of contributions over the life of the fund of about $18.6 million, and then earnings over the life of the fund of about $1.1 million. In fiscal year 15-16, we made contributions of $5.4 million and had investment earnings of about $300,000. So just in summary, our fiscal year 15-16 unaudited general fund results had an excess of revenues over expenditures of about $400,000. That compares to a budgeted deficit of about $2.1 million. So overall, about a $2.5 million improvement, with about $2 million of that resulting from lower spending than budgeted, and about $500,000 of that resulting from higher revenues. Our unaudited general fund reserves as of June 30th, 2016, were $22.9 million, and that represents 13% of net budgeted expenditures, which compares to a projection that we had based on the budget of a $20.5 million ending reserve, or 11.6% of budgeted expenditures. And then finally, our SERP balance as of June 30th was $19.7 million, which included interest earnings over the life of the fund of $1.1 million. And that concludes my presentation. I'd be happy to take any questions.
That's outstanding. Thank you. Any comments?
I have no comments, Mr. Chairman.
Thank you very much. Amanda, you're up for number 2, so why don't you just stay there?
Okay, I will just stay right here. Okay, so then we'll just slide from fiscal year 15-16 into fiscal year 16-17. And this presentation is covering the final budget for fiscal year 16-17. So I'm here this evening to present the proposed final budget to the Finance Committee for your input in advance of recommendation to the full board for adoption, which we anticipate to happen on September 8th. Just as a reminder, our preliminary budget for this current fiscal year 16-17 was adopted on June 9th, 2016. And in that preliminary budget, we had about a $300,000 general fund deficit. So as a result of our final budget process, we are proposing some changes to that preliminary budget. First of all, our general fund revenue is increasing by about $1.4 million, which is primarily the result of revised property tax estimates. So when we prepare the preliminary budget, we have a consultant that does an estimate for us, but that's based on information, the best information that's available at the time, but not the actual tax rolls from the county, which are not available until after we adopt our preliminary budget. So that information is now available. Based on that better information, we're looking at increased revenues. And then secondly, we have an increase in our total general fund expenditures plus transfers of about $3.1 million. And the primary reason for that increase is that we looked at that, what we had intended to spend out of reserves last year in fiscal year 15-16, as I just discussed, but did not. And we said, let's now program that money to purchase additional vehicles so that we can make some progress on our vehicle replacement plan, because we know that's an area where we're going to need to be dedicating significant resources. So we increased our expenditures primarily as a result of adding additional vehicle purchases to the budget, and I'll discuss those as we move into the detail here. And then finally, the final budget reflects the SAFER grant funding of 9 firefighter positions and opening a truck company effective October 1st, 2016. So when we adopted preliminary budget, we weren't aware of the SAFER award and hadn't programmed that in the preliminary budget, so that's a final budget change. So overall, as a result of these changes, we're projecting an 11.5% general fund reserve ratio at the end of the fiscal year, which compares to 11.1% that was projected for preliminary budget. So even though we're increasing our expenditures, the fact that we didn't use the reserves that we had budgeted for last year, plus our improvement in revenues is more than making up for that increase in terms of the result in the reserve fund ratio. So as I move through and talk about the budget in more detail, I'm going to be comparing 16-17 to 15-16, not necessarily talking about the comparison to the preliminary budget. What I'm showing here on this slide is showing you the 16-17 proposed final budget by each of the major funds of the district. As you'll remember, when we talked about the preliminary budget, we've added an IGT fund this year. So you'll see that the column next to all the way over to the right there is that IGT fund. We're not making any changes in final budget compared to preliminary budget, but keep in mind as we talk about comparisons to last fiscal year, and I'll point these out as we move through, that IGT activity was happening in the general fund last fiscal year, and it's now happening in the IGT fund, and then there's a resulting transfer to the general fund. I will be discussing the general fund primarily throughout this presentation, but I also talk about the Capital Facilities Fund, the Leased Properties Fund, and the Grants Fund. I won't talk about the Development Impact Fees Fund, which is the other one you see here, other than to say we're projecting revenue of about $1.5 million. That revenue from that fee is restricted to use for expenses to mitigate new development, so building new fire stations and equipping new fire stations. So we're not projecting any use of that revenue this fiscal year other than the $80,000, which is associated with the fees that were charged for the collection of that revenue. So turning to look more specifically at the general fund, and I know there's a lot of numbers thrown up here, but what these are showing you are starting first with what the budget was for last year, the mid-year budget for last year, and then the unaudited actual results for last year, 15-16, where we were at preliminary budget for 16-17, and now what we're proposing for final budget for 16-17. And then the variance column to the right is going to compare that final 16-17 budgeted number to the unaudited actual results for 15-16. So looking first at revenues, you can see that we're projecting revenues in final budget of about $178.9 million compared to total expenditures in final budget in the general fund of about $179 million. So really just a slight difference between the two of about a negative $200,000 revenues less expenses in the general fund. And then moving below that revenues less expenses line, you're seeing the transfers in and out of the general fund from the other funds. So the most significant of those are the $7.6 million that's going from the general fund to the Capital Facilities Fund, and that's to fund the cost of capital purchases and debt service in the Capital Facilities Fund. And then also the other large transfer number you see towards the bottom is the $5.9 million that's coming in from the IGT fund to the general fund. And again, that activity was budgeted in the general fund in 15-16, which is why when you look at some of those variance numbers to the right, you see the big swings because you were seeing that in the revenues and expenses and not in the transfers in 15-16. Overall, the bottom line result for the general fund is a deficit of about $2 million, rounding up. And you can see that compares to the $300,000 deficit at preliminary budget. So it's increasing the use of reserves in 16-17, but it's really more than made up for by what we saw in 15-16. So if you continue to look at that bottom line, but the first two columns, you can see that we had budgeted for a use of reserves of about $2 million and instead added approximately $350,000 to reserves. So we're sort of taking that use of reserves and reprogramming it in 16-17, largely in the form of that increased transfer to the Capital Facilities Fund. Just moving to look a little bit at the history of general fund revenues. This is a chart you're probably familiar with seeing by now, but updated for our revised revenue numbers for 16-17. You can see that with our projected property tax revenues for the year of $131 million, we're sort of for the first time getting ahead of where we were in fiscal year 2007-8, the beginning of this chart, in terms of property tax revenues. And then you can also see over that period of time that we've been able to diversify our revenues so that the lighter blue shaded portion has grown from accounting for about 20% of revenues in 2007-8 to about 30% in 16-17. So looking a little bit more closely at the distribution of revenues for fiscal year 16-17, of our total revenues of $179 million, about 73% is going to come from property tax revenues, and about 20% from our medic cost recovery, with smaller amounts coming from other revenue sources. I do want to point out that because we're talking about the general fund here, this is excluding IGT, which is now budgeted in the IGT fund, so this is strictly general fund revenues that we're looking at. So as I mentioned, we have a general fund revenue budget of $179 million. Overall, that's a $1.9 million increase compared to the unaudited results for fiscal year 15-16 if we exclude IGT from the 15-16 general fund revenues. So trying to do a more apples to apples comparison there. Property taxes represent a $5.1 million increase, or about 4% year over year. We do have $1.2 million of one-time GEMT revenues related to prior year reimbursements that have been held up in the 16-17 budget, so that would represent an increase over 15-16. I'm going to mention again that we will monitor this throughout the year, and if as we get to mid-year budget it doesn't appear that there's been movement on that and that we are likely to receive that money this year, that would come out of the budget at this point, and and we would be having the same conversation next year. A couple other things that I wanted to point out, we had $1.3 million of financing revenue in our 15-16 revenues related to the radio purchase and the financing of that. Obviously, we don't have that revenue in the 16-17 budget because we don't have a related purchase. And similarly, we had $3.7 million of deployment reimbursement budget that received in 15-16. Actually, it was about $4 million received. We have about $300,000 budgeted so far in 16-17. We're going to, which essentially represents a conservative estimate of what our administrative fees would be. We will add in what we expect our deployment reimbursement revenue to be at mid-year budget based on what our actual experience for deployments has been. So that's just one of those, again, adjustments looking at an actual result compared to a final budget year that we just need to keep in mind. And then our net IGT revenue that's transferred into the general fund is $5.9 million for fiscal year 16-17. So while that's not a general fund revenue, it is a source of funding that's coming into the general fund that can be used to fund general fund expenditures. And that's a $3.3 million increase compared to the IGT revenue that we had in the general fund in 15-16. And the primary reason for that increase, if you'll remember, is in 15-16, there was only a 6-month reimbursement that we were getting, and we're now back to getting a full 12-month reimbursement. So after you adjust for all of those factors, the IGT, the financing, and the deployment, the net increase in available general fund resources is about $10.2 million. So turning to look at our budgeted expenditures, we have a total expenditure budget in the general fund of $179 million. And you can see that 86.5% of that is labor, with 11.7% being services and supplies, and the remaining 1.9% being taxes, assessments, contributions, and debt service. Looking at our general fund labor costs, we have a $155 million labor budget, which is up $3 million compared to the unaudited results for 15-16. Adjusting for those deployment expenses that I mentioned, we have in the 15-16 number, but not yet in the 16-17 number, the net increase is about $6 million, or roughly 4%. Some of the changes from 15-16 include the opening of an engine company on July 1st, and now the budgeting for the opening of a truck company on October 1st. Although I'll mention, a significant portion of that, the cost of that truck company is covered by the grant fund and the SAFER grant, but we do have a general fund impact. We also have the implementation of new labor agreement terms, increased pension rates. So I think I mentioned at preliminary budget that our PERS safety rate has gone from 38% to 42%. We also have an increased cost for our SCRS liability. We have the cost of additional filled positions, but offsetting that is that we have reduced overtime. So our budgeted overtime for 16-17 compared to the preliminary results for 15-16 represents a reduction of about $4.7 million, or about 34%. And that's really as a result of those additional filled line positions. Looking at general fund services and supplies budget, we have a total services and supplies budget of $21 million. And that's overall a $4 million reduction compared to fiscal year 2015-16, but that's entirely due to the fact that IGT expenses are now pulled out of the general fund and reflected in the IGT fund. So excluding the IGT total expenditures, the total expenditure cost is essentially unchanged from last year. There was a $2 million decrease related to some one-time expenditures in 15-16. I mentioned the radios earlier, that's one of those. We had some helicopter maintenance and also a cost for a new CAD system. And that decrease was offset by increases for election services, software, vehicle maintenance, and various other expenses. Our final general fund expense category is the debt service assessments and contributions. That budget totals $3.3 million. $1.8 million of that is the assessment that's paid to the county for the collection and administration of property taxes. And then we have debt service payments totaling about $1.1 million. You can see those listed below. And then in addition to the revenues and expenses in the general fund, as I've talked about, there are the transfers in and out of the general fund. So overall, the net transfer from the general fund is $1.7 million. That's made up of a $7.6 million transfer to the capital facilities fund, and that's a $4.8 million increase from last year's activity, again, related to those additional capital purchases that are programmed. We have a $5.9 million net transfer coming in from the IGT fund, about $70,000 being transferred out to the grant fund for the general fund share of the grants, and then $40,000 transfer in from the deferred compensation reserve to offset the deferred compensation expenses. So turning to look at the Capital Facilities Fund, I'll probably focus on that final fiscal year 16-17 column. You can see in the total revenue line that we're projecting total revenue of about $6.1 million, which is almost entirely our financing proceeds associated with the capital purchases that will be made. Looking at the expenditures, we have debt service in the Capital Facilities Fund of about $3.5 million. Capital outlay, so those are the capital purchases, of about $10.3 million. You can see that's a substantial increase from both the preliminary budget and the 15-16 results, for total expenditures of $13.8 million. And revenues less expenditures of $7.8 million, which is requiring the transfer in from the general fund of about $7.6 million. And you can see that we have negative revenues less expenses plus transfer number down at the bottom of about $122,000, and that's really related to the use of existing fund balance to fund some capital purchases that were programmed for last year. The money was transferred from the general fund last year, but the expenditure wasn't incurred and will instead be incurred in 16-17. So as I mentioned, there's that net funding requirement coming in from the general fund to the capital facilities fund of $7.6 million. That's created by this $10.3 million of capital outlay, which is partially offset by $6.1 million of financing proceeds coming in. We also have a $3.5 million debt service requirement, with $1.3 million of that being related to the $6.1 million in financing. So we're going to finance $6.1 million of cost, and we'll have debt service associated with that of $1.3 million. Some of the major capital purchases that are included in that $10.3 million number are $2 million for a station alerting upgrade. And then the next three items that I have in red are items that were added in this final budget process, so not included in the preliminary budget. So an additional cost of about $1.3 million for it's actually 3 additional ambulances. So we had originally budgeted for 6, so that's $1.3 million total. And then we have 2 Type 1 engines, $1.3 million, and then aerial ladder truck of $1.1 million, and mobile data computers of $1 million. And turning now to look at the grant fund. Again, I think I'm going to just focus on the final 16-17 column. We have 3 grants that we're budgeting activity for in 16-17, totaling $1.5 million in grant revenue, if you look at that total revenue line. The largest of those is the SAFER grant, so we have about $1 million that we're budgeting for the funding of 9 firefighter positions. Also included in that revenue number is about $400,000 for the AFG grant for the chest compression devices. And then we have about $100,000 for the completion of the fire prevention and safety grant for the residential care facility inspection program. Looking at the expenditures, the $1.1 million in labor cost is primarily related to the SAFER grant. We also have about $50,000 in services and supplies costs related to the fire prevention and safety grant, and then the $430,000 in capital outlay that you see is related to the purchase of those chest compression devices. So overall, there's about $70,000 that's coming in from the general fund to the grant fund that represents the general fund share of those grant expenditures. And then the last fund that I'm going to discuss is the leased properties fund. Again, looking at that final fiscal year 16-17 column, we have total revenue of $700,000. You can see, comparing that to fiscal year 15-16, that is a reduction of a little bit less than $500,000, and that reduction is the result of assuming 6 months of no lease revenue for the first floor of this building due to the expiration of that lease at the end of the calendar year. We have expenditures in that fund of about $800,000. There's a small transfer out that needs to occur as a result of an adjustment for some prior year debt service, and then the bottom line revenues less expenses plus transfers is a negative $150,000, and that's going to be funded with existing fund balance in the leased properties fund. So we're not making up that deficit with a transfer from the general fund. And that concludes my presentation, so I'd be happy to take any questions you have.
Thank you for your presentation, and it was on my mind already that we will not have a tenant downstairs, and so I'm anxious to hear a plan to find a tenant for downstairs. Oh, excuse me. You probably couldn't hear me.
I could hear you.
Excellent.
Thank you.
Ms. Thomas, I have 2 questions. In the Capital Facilities Fund, saw the vehicles and the other things we're going to get. We have about a $2 million, $2.5 million expense coming up for SCBA's. Is that accounted for in this fiscal year, or is it going to be 17-18?
So the SCBA's will be a 17-18 expense. So we'll see that in the 17-18 budget.
And the other question was, we had a budgeted overtime, you said was reduced by about $4.7 million in this upcoming budget versus the prior one. Mm-hmm. What did we end up with as a total overtime expenditure in 15-16?
You have to give me just a second to find that number. So our total constant staffing callback Expenses for 15-16 were $16.4 million. However, that did include a callback for deployment of, I think, approximately $2.7 million.
So our non-deployment overtime is going to be just under 14 million?
Correct.
Outstanding, thank you. Anything further?
No, Mr. Chairman, says presentation takes no action, right?
Nope, no action. We'll look forward to seeing this in front of the full board. Thank you.
Thank you.
We still don't have
Director Jones.
Director Jones here, so we'll table the consent calendar until the next meeting, when hopefully all three of us will be here.
Does it work if we wait that long?
I would say that the minutes can definitely wait. Amanda Thomas, the quarterly investment report, that's okay if it goes for another. Okay, yes, that's okay as well. So I would say that we're safe to wait until the next.
Right people in the room.
Yes, thank you.
All right, thank you. Then there being nothing further, our next meeting will be on September 22nd, 5 o'clock in this room. Look forward to seeing you all then. Thank you.